Hey everybody, I'd like to welcome you here tonight to another one of our webinar series. I am very happy to present this next topic. I know it turns out to be one of our most highly attended webinars that we've had. It's kind of interesting because the subject line that you're all listening for is the biggest mistake I have made in multifamily. So you all obviously want to hear what my pain is in this business. And I'll be more than happy to share that with you and hopefully to teach you the mistakes that I've made, but more importantly to help you make sure that you don't make the same mistakes that I did. Now, helping me today is my friend and fellow member of the bar is my buddy Jeff Lerman. Jeff is an attorney out in California, and he works out in the Oakland area. He specializes in working in business law, setting up entities, and more importantly, he has a great depth of experience in the topic that we're going to delve into today, and that topic happens to be partnerships. Now, let me introduce and welcome on board Jeff. Are you there?
I am, Charlie. How are you today?
Good, good. Thanks. Well, thanks for coming. I appreciate you being here.
My pleasure. Thanks for having me.
Thanks. Now, I always say that the biggest mistakes that I have made in this business have all been the result of not setting up my partnerships correctly. And not only does that mean from a entity structure standpoint, here I am as an attorney myself telling you these stories, but more importantly is making sure that you are doing business with the right partners. And we're going to talk about how to protect yourself and make sure you don't make the same mistakes that I did in our discussion. So, Jeff, I just got to tell you that I was speaking one time to a California attorney, and the thing is that in California, she told me that the bar passing rate in California is 25%. And I said, wow, that's pretty impressive. And she said, yeah, where do you practice? And I said, well, I'm licensed in Massachusetts. And she says, oh, we have a term for Massachusetts. I said, really, what do you call, what's your term? She goes, we call Massachusetts Passachusetts. And I thought, wow. It turns out like, yeah, 90% of the people, Massachusetts has a 90% bar passing rate. So the rest of the country kind of looks at California attorneys slightly differently, Jeff. So
that's interesting. That either means that your exam is easier, or you guys are just a whole lot smarter than us dumb California lawyers.
Well, let me tell you, I think it's more of the former rather than the latter, believe me.
Okay.
So.
All right.
All right, so why don't we get started, Jeff, and let's talk about partnerships and where you see some of the problems. And I'll start adding some of my personal and some of my professional experiences regarding partnerships as well.
Sure. So I think big picture concept, one of the most important takeaway points for everybody listening tonight is that a partnership is truly a business marriage, and that concept ripples through so many of the issues we're going to be talking about tonight and at your upcoming event. So many of the same ideas, strategies, principles that will either make your partnership successful or undermine it are true in a marriage, and the most important point is communication. We'll get there but with a lot of different examples during the next few minutes, but we're also going to be going into some important subtopics of that as we get into the topic in Anaheim. But let's talk about why I really like using partnerships and why I think that everybody should. I truly believe that partnerships are the cheapest, easiest, fastest, and safest way to reach your real estate success goals. This is something which I have seen over and over again on a personal level and on a professional level, and I think before we even really get into the substance of the right ways to do it, the wrong ways to do it, this is an important aspect of the topic, and it's really just mindset and getting this concept. So let's talk about this a little bit. And to clarify, when we're talking about partnerships in this context, I am not talking about syndication. I am not talking about the securities laws. I am talking about when you have two or more people involved in a joint venture, for lack of a better term, in some business purpose, whether it's buying real estate or any business, where all parties are actively involved. And that's always going to be a question of fact when you're actively involved or passively involved. But for today's purposes, let's just assume that anybody who is just writing you a check and handing it over to you and sitting back and waiting for you to pay them a return on their investment, that's the typical definition of a passive partner. And that's when you have a security. That's not what we're talking about. We're talking about somebody who's more actively involved than that.
Okay,
so,
let me just clarify something. And at this point, as you said, we're talking about the 30,000-foot view. It could be any type of business structure that we end up using. We're just now talking about the relationships within that entity, correct?
Yeah, absolutely true. Yeah, thank you for pointing that out. You know, partnerships is actually a type of entity. I mean, you can have limited partnerships, which before LLCs were enacted all over the country, that was the usual way that people did business in real estate. They formed limited partnerships. And so I'm using the term broadly in that sense, and I mentioned joint venture. But yeah, a partnership can refer to any type of entity whereby two or more people come together. So you could be talking about a corporation, you could be talking about an LLC, you could be talking about a limited partnership. That's my buzzword just for purposes of talking about this concept of two or more people coming together in active capacity.
Gotcha.
Hear these concepts, because this will open your mind to why this is something you really need to strongly consider doing if you're going to get to where you want to be faster. It is the cheapest way to accomplish your goals, because think about it. You've got a certain limited resources, a certain amount of time in the day. You got a certain amount of financial resources, whatever it is. And if it's just you, if you're a lone ranger and you're doing everything, you're doing it all by yourself. You find all your deals, you do all the due diligence, you bring all the money to the table. It's all you. Then that's going to be like trying to get in a car and have one foot on the accelerator, one foot on the gas, and one foot on the brake. You know, you're always going to be limited by how much time and how much money you've got. But if you can take your money and bring other people in the deal, so you're doing deals with other people's money, again in a joint venture capacity, then you can just stretch your dollars. The money that you have can go so much further. You know, I just did a refinance on one of my buildings, and I'm now looking to use that to reinvest and do some other deals. And so I can either take all that money and just do one deal by myself, and I'll own 100% of that deal, or I can take 1/10 of that pie, 1/10 of that total money, and I'll put 1/10 as seed money in this deal and 1/10 as seed money in that deal, and bring partners into it to help out with the rest, and that will just exponentially increase how much wealth I can create, and that's a key point here. It's also the easiest way to get to your goals because, again, going back to your time, which is your most limited resource, if you're doing it all yourself, there's only so many hours in the day, and you can accomplish so much more if you have the right strategic partner working with you towards the same goal. So if you want to get to your goals faster, then you will have the right strategic partner who can bring whatever you need the most of, whether it's a skill that you don't have, whether it is financial resources you don't have. You know, as Charlie said, I am a full-time practicing lawyer. And so for me, my biggest challenge is that I don't have as much time to sift through all of the garbage deals to find that needle in the haystack. And so for me, the best strategic partner, the one that I'm looking for, is somebody who's got the skills to find good deals and qualify them and understand what I'm looking for and say, here's a deal that I've looked at, makes sense, and I think this would be a good fit. To me, that would be a great partner, and that's what I have in the partners that I'm working with right now. So you got to ask yourself.
Yeah, let me ask you about that, Jeff, because that is one of the problems that I've seen come up over and over again. And I see this at my seminars when other partners, other investors come together and they love this concept of partnering. They're trying to find the right person. How do you choose who the right partner is? You know, I've been in some partnerships where, you know, people come to the table, say they can do all these great things, and then it never pans out. So how can you go through the process of making sure you get the right person?
Okay, well, before you even answer that question, you have to ask yourself what is missing from my current business model that is preventing me from getting what I want. Is it somebody like me that doesn't have enough time to do that one component? Is it somebody who has money that I need to do deals? Is it somebody who's got better credit than I do that can get the loans? Is it somebody who's got the experience and the track record that will give me credibility that I need to approach a seller and get a deal? I'm working with somebody right now, and they are a very impressive, it's a couple of people, and really impressive people, but they're young. They're in their mid-20s, and they've accomplished a phenomenal amount of success in the relatively short period of time they've been doing what they've been doing. But they may have a challenge when they are talking to sellers that they don't have the long track record that we do. We've been doing it. We've been in this business, in the real estate development and investment business in our family company for decades, for over 50 years. And we've got a great track record, and that is when you're trying to do deals, and especially larger deals, you know, over, say, 100 units, you know, that is usually the your admission ticket just to even present a purchase offer. A lot of times they won't even talk to you until you can give them a proof of funds letter and show them that you're credible. And if, you know, so that's, in this particular relationship, there's a good fit there because they are able to find deals that I'm interested in, and I can bring some credibility to the table when they're talking to sellers. So that's the first thing you got to do, is figure out what it is the right partner looks like to you. Don't find somebody who's just redundant of your skill sets. What are you missing? What are you missing from your business model? And then once you identify that, what you're looking for, once you get crystal clear on your focus, then there are a lot of different ways that you can go about finding that person. For example, I have a LinkedIn group that I created because I firmly believe that joint ventures are such a great way to not only do business but also to find deals faster and find off-market deals. So I kind of like the idea of talking to somebody who's already done whatever they feel is necessary to find a good deal, and now they're looking for a partner. And so at least once I believe that person has certain credibility, I could say, okay, they like the deal, bigger chance that I'm going to like the deal as well. So I created a LinkedIn group called Real Estate Joint Venture Matching Group, Real Estate Joint Venture Matching Group. And you should go on LinkedIn and check it out. We have over 2,000 members, and I manage that group very hands-on. I just don't let anybody in, and I don't just let any discussion post make it on the group. I look at every proposed post, and I weed out all the promotions. I put it in the promotions tab. I make sure that the only thing that gets in our group is somebody who is looking for money to do a deal, or somebody who has got a deal and they're looking for a partner, or somebody who's got some great financing for people who are looking for joint venture type financing, and with that kind of group, I get first look at all those deals because I'm the manager, and all those discussion posts have to go through me.
Right.
But I'm sorry, Charlie, were you saying something?
Oh no, I was agreeing with you. I know exactly what you're talking about. I mean, I love your group, and if anyone's listening here, you've got to go. Jeff just gave you the name of the group. You've got to go sign up and get on board. Even if anything, just to sit on the sidelines and watch the conversations that take place on that board. It's fascinating. It's great stuff.
Yeah. Again, it's Real Estate Joint Venture Matching Group. And I think the tag on it is find a joint venture partner here. So, that's one way, because then you can very quickly, and we usually get about 40 new posts a week on that site. And you can just sift through and see what you like and go for it and check it out. You can also, of course, go to your local real estate investment associations, the meetups, and get very focused on why you're there and be very clear with people as to what you're looking for. And, in these networking situations, don't be a passive networker that just, once you start talking to somebody, you just automatically talk to them for 5 or 10 minutes just to be polite. If it turns out that you can, like within a minute, realize that this is not a good fit, figure out a polite way to move on. And these RIAs are a good way to do that kind of networking. And also through your professional advisors. I have a great CPA, and I tell my CPA what I'm looking for. And by the way, you should tell all of your business advisors what you're looking for. I tell them this is the specific kind of skills that I'm looking to find in a partner. And when I told him that, he instantly said, "Oh, there's another client I've got who you should meet." And he fixed us up, and within 30 days, we were doing a deal together. So, I think those are the top 3 ways that you can go about finding the right partner. We'll go into a few more when we do this event, do this talk in Anaheim. I don't know, Charlie, what has worked for you?
Well, it's interesting you say that, because just on the other side of my walled office here is my property accountant. And I am constantly going in there saying, we got this deal right now. We're working on a 200-plus unit deal, and he's just a very sobering voice to make sure that I'm doing everything correctly. And it's great to have those types of people on your team to make sure you're doing it right. You don't want to have just a bunch of yes men, because
Right.
nothing's can kill your deal faster than doing the first deal wrong. So, getting the right people on your team as far as and what you're talking about aren't necessarily partners, just more the experts on your team to help you meet those right people. So.
Well, yeah, for sure. And I got to say, and I'm not just saying this because you got the Anaheim event coming up, but I think no matter how good the content is going to be at your event, and I know it'll be great, but what I think the biggest reason for people to be there is to get in a room full of like-minded investors who are all coming there with something they need. I don't know anybody, and I have clients, and I move in circles where there are people who can do it all by themselves. But I don't know anybody who couldn't be more successful without the right partner and who doesn't have a need. So at your event, people come there, and they will, I'm sure, during the course of the couple of days they're going to be there, during all the breaks, they're going to have an opportunity to network and get deals done right there in the hallways.
Exactly. I actually have one of my clients who, when he started with me, he didn't own any multifamily. Now he owns over 1,400 units around the country. He actually comes to my events just to meet other new investors who are out there finding deals so that he can be their key sponsor. And so if you're looking to put together a deal and you need somebody on your team that can qualify as a key sponsor, he's the guy you want to meet at my events. So, I mean, there's a whole host of different resources available to you when you come to these multifamily Shark Tank events in order to build your team to get your first deal done.
Yeah. So, and to get back to the mindset, the reason I think using partnership to get what you want is the safest way to do it is for a couple different reasons. Let me tell you a story, and then I'll talk about the concept in more detail. So my father-in-law is, I said we have a family company. It's my father-in-law and my brother-in-law and myself. He started in the business over 50 years ago, and he was selling flowers. He had a flower shop, and he wasn't even doing real estate. And the guy walks into his flower shop, and he's an airline pilot, and he's doing deals. And they started talking about my father-in-law said, I want to get into real estate. And he said, well, you know, you got a piece of land next door. Why don't we build a duplex there? And so they say, sure. And so they started doing that. And then one deal after another, after another. And before long, they had developed thousands of units together. Now, they didn't, after the first 3 or 4 deals, they really didn't need each other anymore. But in terms of they both had the skills, they both had the resources, they both had everything. But what they had between them was that chemistry, that whatever it was that that enabled them to get that kind of success, just kept feeding on itself. Whether it was the mutual accountability, whether it was a natural development of their business marriage where one guy became the deal finder and the other guy was the key schmoozer who was out there bringing other money to their deals because they were doing syndications. You know, so, and that partnership lasted for decades. So
let me add to that, Jeff, because a funny thing, I happen to have the same father-in-law type of story. My father-in-law was a physician, and he, you know, saw that the city block that his office was on was going up for sale. So he got 9 other doctors together, and they all syndicated their funds together, and all became equal partners in this city block. And then he went to each one of the doctors separately and said, if ever you want to sell your shares, your membership interest, come talk to me. I'll buy you out. And so to this day, he owns 60% of the block, and another doctor owns 40%. So the original 10 are now down to 2. And you know, he's 75 years old. This whole building is his retirement income. And
nice.
You know, and from that point on, he did go out and start to build a lot of other real estate properties as well.
Right, right. Well, but the reality is this: real estate can be a very lonely, isolating business. You could sit at your computer all day long looking at deal after deal after deal, and at some point, if you're going to pull the trigger on a deal, it is always, I always look for at least one sounding board before I pull the trigger, just to get a reality check. Sometimes you get too close to a deal, and even if it's just my CPA, who again is he's just an entrepreneur, he's an investor himself, and I say, this looks interesting to me, what do you think? It's great to have a partner that you can use as a reality check, and it's all about, you know, doing this business to mitigate your risks, be prudent, be a risk taker, but be smart about the risk you take. So that's what I mean by it's the safest way to do deals. The other thing is that investing 101, diversify, right? Whether you're doing securities in the stock market, or whether you are a real estate investor and you're trying to diversify your risk by buying in different geographic areas, by buying different product classes, whether it's a development deal or an existing deal or a certain size building, whatever it happens to be. If you can go back to the example of buying just one building, putting 100% of your resources, 100% financial resources in one deal, or using your money and putting 1/10 of it in 10 different deals to diversify your risk, that's a safer way to do this business. So those are the main benefits that I get from doing partnerships in my world. But there is like everything else, there are pitfalls and there are traps for the unwary. And I want to go back to where I started, that this is a business marriage. And we all know what the statistics are for divorce. And so what you need to understand, and like you were saying, Charlie, at the top, there are partnerships can get nasty. I'm a litigator as well as a transactional lawyer, and I can tell you that a partnership dispute that results in a lawsuit can be one of the most expensive, painful challenges to go through in your career. So I'm all about making sure that when you do set it up, that you set yourself up to win. You set yourself up to succeed, and because some of the things that can happen if you do get into a dispute is you could be dealing with lost profits. You could be dealing with significant legal fees. I mean, just to get through a mediation of a partner dispute, best case scenario, I think you're looking at $20,000. If you go all the way to trial, you're looking at easily at a six figures in legal fees. There's the opportunity cost, the time, money, and effort that you are investing in resolving that dispute is time, money, and effort that you could be investing in finding new deals. It's all that non-revenue generating time, the time you have to spend dealing with your lawyer, dealing with the discovery. It's the physical burden, the stress. It's the burden on your health. It's the emotional drain. It's the anger. It's the frustration. It's the psychological toll. It's the distraction. It's all of that. Now, I had a client who I represented in a partner dispute, and it was him and one other guy, and they were involved with 3 real estate development joint ventures over a 10-year period. So a lot of history there in 10 years. They were involved in a multi-million-dollar dispute, and the main issue in the dispute was how additional capital infusions should be characterized. Specifically, my guy was putting more money in the deal because it needed it, more money than they had originally agreed upon. And so the main dispute was, okay, should that additional money be treated as a loan or as a capital contribution? And that was basically the key issue. And I will just tell you that, and this, to resolve this dispute, and we went through arbitration, not even a trial, we went through arbitration. From beginning to end, that dispute lasted about 2.5 years, and this guy that is my client is a very, very successful guy. A lot of money, done a lot of deals, and it was, I could see the toll it was taking on him for all the things that I just rattled off there, all those the burdens, the lost profits, the legal fees, the emotional drain, the psychological toll, beating himself up. You know, how could I do this to my family, et cetera, et cetera. So what we're all about and what we're going to be getting into in detail in Anaheim is 17 steps that you need to take to set up your partnership to win. So let's just go over a couple of these today.
Hold on. Before you go on, let me talk a little bit about what you just described there. The example that you just gave happened to be with an investor who had years of experience and years of a relationship in that partnership, and he still ended up in that situation. And the issue that I see happen many times is that a lot of new investors will get involved in partnerships thinking that, oh, this person is going to bring certain resources to the table that I do not have and that are very valuable to me, and they never can truly quantify the value of those additional resources. Let me give you an example of what I'm talking about. So many times I see, I get calls from clients and mentorship students, and they say, I found this guy, he says he can bring money to the table, and he wants, the two of us are going to work together and split the deal 50-50. And I've been involved in those situations before. I've seen those types of relationships where somebody says that they can bring money to the deal, and that's the toughest part for new investors. So they latch on to those types of people and bring them into the partnership 50-50. And what they don't realize is that in the whole scheme of things, getting the money to the table is the easiest part of the deal. And once that money is at the table, the person who brought it there is done. And now they own 50% of the deal or 50% of your partnership, and they're not doing anything more. But you still have to get up every day and go to work and make sure that that property runs soundly, and it really starts to cause a lot of problems in partnerships when investors or partners are not working anymore in the partnership because their role is done.
Right. Right.
Yeah.
Well, so let's talk about what I believe is the single biggest type of dispute that is most frequently litigated in partnerships. That's what I think everybody here really needs to understand. And it's, you go into these partnerships so often focusing on just the what you're trying to accomplish, and the positive is normal, but you don't think about how do we look down the road and how do we get out? What's our exit strategy?
Right.
Because a lot of times, by the way, so many of these partnerships, and you end up doing it with friends and family, which is a whole thing we'll be talking about in Anaheim. I get it.
Oh, great topic.
Yeah, yeah, and look, I'm all in favor of it. I've done business with friends and family, and I've dealt with people who say never will I do business with friends or family, and there's no right or wrong in that. That's part of that's a personal philosophy.
Right.
But when you do business with friends and family, that is so frequently what results in disputes, because you tend to get sloppier about how you set your deal up, both in terms of what you talk about and how you document it. But you got to always say, okay, what are our exit strategies? Even if you're in the deal, not for 20 years, but 3 years or 1 year or 6 months. So the usual things that will result in the deal being ended is, besides just selling the asset, I'm talking about a premature exit, a premature termination. Death, disability, withdrawal, expulsion, bankruptcy, and divorce. Let me go through those one more time. Death, so obviously, God forbid, something happens to your partner. Disability, your partner becomes incapacitated either mentally or physically. Withdrawal, where for whatever reason, you or your partner decide you want to pull out of the deal before the date that you had initially agreed. Expulsion, so if your partner turns out to be a deadbeat partner, how do you get rid of your deadbeat partner? Bankruptcy, what happens if your partner goes bankrupt? Divorce, what happens if you are with a partner and your partner gets a divorce, and all of a sudden your partnership interest becomes part of the dispute in divorce court in terms of who ends up getting your partner's partnership interest. And there might be some other things that could cause an early termination that might be unique to your particular situation. But those are the things that we typically call trigger events, okay? And where these usually get addressed is in something that we call a buy-sell provision in any agreement. Let's just stay with an LLC for a moment, and let's just say it's an operating agreement. So these are all typically addressed in a buy-sell provision. And you have to say, okay, what's going to happen in each of these instances? And it's not a one-size-fits-all answer. Let me give you an example. I had a client. The client was two guys, and they were both married, and they were friends. And I got to this particular discussion point when we were going through setting up their operating agreement. And I said, typically what happens is that if something happens to one of the partners, then the other partner gets to decide. They get the option, the right but not the obligation, to buy out their partner's interest. So they can either keep the partner's heir, in this case the wife, in the deal, or they can buy out the partner's interest. And that's the way that's the way these things typically go. The concept being that when you get into a partnership, nobody should have a stranger forced upon them as a new partner. And so you typically let that power, if you will, go to the surviving partner. Well, in this situation, these guys said, you know what, if something, God forbid, happens to me, I don't want my wife's financial destiny to be decided by my partner. I want my wife to have that power. And both of these guys had such a good relationship with each other and their respective wives that they said, you know what, I'm fine if something happens to him. If I'm going to be dealing with her, I'm fine with that. She's, she's great. I love her, and we would, we'll be great partners. And so in that scenario, what we did is we ended up taking that default, that traditional approach, and we flipped it around. And we said, in that situation, the wife gets to decide if she wants to be a partner, stay in the deal, or if she wants to be bought out. So this, this takes us to another point, which is what I see so often as a litigator. I see somebody come into my office with some form that they pulled off the internet that tries to be a one-size-fits-all, regardless of who you are, how many people you got, what the beliefs, personalities, relationships are amongst those people, no matter what state you're in, no matter what the law is of that state, and they come in with this form, and the form doesn't address your unique concerns and needs. And so this is a multi-million-dollar, usually, a multi-million-dollar issue, a multi-million-dollar transaction. And so I really encourage you to take it seriously and get a document that is customized to your unique specific needs, concerns, and objectives. The related issue is, how do we value interests on early withdrawal, on when one of these triggering events that I listed a few minutes ago happens? How do we value the interests on early withdrawal?
Jeff, let me interrupt and just add a little bit of color to what you just said. So many times people will say, try to make light of the relationship and say, well, it's my brother. I don't need a document. I don't need to have anything in writing. He's my brother. And we get along great, and our spouses get along great. And I said, listen, the problem is not going to be with your brother. The problem is probably not going to be with your brother's widow. The problem is going to be with your brother's widow's next husband. And that's why you need to have these things in writing.
Great
when
point.
You put it in that perspective, they say, whoa, you're right. And that goes directly to what you were saying, Jeff, about not forcing a partner to have a stranger brought into the deal. And that's that's a great point.
Yep. Charlie, do I have a couple more minutes to go over this next
Yes,
point?
absolutely.
Okay.
Yep.
All right. So this this final point I want to address is, so everything that I listed, death, disability, withdrawal, expulsion, bankruptcy, divorce, those are what we call triggering events. So the next question is, okay, what happens if one of those triggering events occurs? And so there's a buy-sell. And one of the issues that is, again, disputed most frequently is, okay, if I'm going to get bought out, what are you going to buy me out at? Or what do I have to pay to buy you out? There is, and if you don't agree on this issue up front on day one, when your relationship with your partner is without question the best it will ever be, it's from that point on, hopefully it'll be better, but more often than not, when life starts to happen, things happen, and it's never going to be as strong and as good as on that first day. So if you don't agree on this on day one, when you don't know who's going to be the buyer and who's going to be the seller, then my concern for you is that it's going to end up getting resolved in some sort of an arbitration or court, and it's going to be some stranger who's a judge or a jury who's going to end up deciding this for you. A lot more expensive to do it that way. So what you want to do is you want to say, how do we value our interest on early withdrawal? It is a two-level analysis. It's a two-level analysis. Here's what I mean by that. Let's say you had a joint venture that owns an apartment building. Then you got first the asset itself, the underlying asset. How do we decide what the apartment building is worth on the date that we are having this buyout. And there are different ways you can do that. I mean, it can be as simple and as quick as the partners just agree that we think it's worth X. Or you can get a CMA, comparative market analysis, from a broker, which is typically no charge. And they can say, okay, we think it's worth whatever. And you can say, we're going to be bound by that, in which case you should probably try to agree up front on who that broker is going to be, or if not one particular broker, at least one particular brokerage company that you both feel is has sufficient expertise in this particular asset class to that you're comfortable with it, and they're sufficiently neutral. It can be an appraisal. It could be on a larger asset. You might want to go with 2 appraisals, or I've even seen 3 appraisals. It can be, as I've also seen, by the way, going back to the fastest way to do it. If you really can't decide, you can do something as what sounds silly as flipping a coin between this and that, one value or another. I know that's laughable, but I'm telling you that I've had partnerships where I laid all these options out, and that's what the brother and sister agreed. You know what? If you think it's worth X and I think it's worth Y, we'll just flip a coin. And that was what, against my advice, but that's what they did.
Hey, but Jeff, they had a whole movie about that one time for Secretariat. I mean, the family that got Secretariat won it by a coin toss.
Didn't see the movie, but that's a great story.
Yeah, that's true. Story. Yep.
And so the asset itself is the first valuation decision you have to make. And then the second aspect of that analysis is the value on your particular interest. Here's what I mean. Let's say that you're in a 50-50 deal, and so neither of you has a controlling interest. Each of you have a non-controlling interest in the deal. If you went to the secondary market, if you tried to take your non-controlling interest and sell it to somebody else, it's going to be worth less than if you have a controlling interest. And you need to decide if there will be some sort of a pre-agreed discount factor applied on the purchase price of your interest because of that. Now, it could be anywhere from 0 to, I've seen it to be as much as 25%. And it usually ends up, I see usually somewhere between 10 and 15%. But again, I've seen it on both ends of that spectrum. I've seen people say, you know what, I don't want to play that game. Let's just say if the property is worth $10 million, then your interest is worth $5 million. It's our job, my job as your counselor, is to simply educate you, make sure you make an informed decision. But the key is that you think about it in advance and not have to go to court and have some stranger decide it for you.
Exactly. Yep.
So that's if you just follow these, and the nice thing about this, and this is what we try to do, and this is what I will do when I see you in Anaheim, is I will take. I think that one of my skill sets is to take the complicated and make it simple. And I promise you that when I stand in front of you and take concepts like this, I will spoon feed it to you. I will break it down and give it to you step by step, almost checklist fashion. So you will have a roadmap that's easy to follow for you in making sure that when you sit with your prospective partner, that you can take this roadmap for your discussion, and you can talk about the things you need to talk about, and then you can sit with whoever it is, whether it's with me or whether it's with some other lawyer, your current lawyer, and at least go into that meeting having discussed what I will estimate 90% of partners never discuss, and go into that relationship with the risk of a problem mitigated about as much as you can mitigate it. So that's what my commitment is to you when I see you in Anaheim.
That's great. I appreciate it. So for those listening, Jeff is going to be joining us in the Multifamily Shark Tank event in Anaheim on March 28th, 29th, and 30th. And he's also going to be one of the moderators or one of the participants in the Shark Tank event, which occurs on the end of the at the very end of our session. Now, I think Jeff is actually going to bring some very interesting perspectives to the event, not only because he's going to be there one of the days talking more in depth about partnerships, but he's also going to be one of the moderators, as I said, coming from a guy that deals with JV partnerships and JV arrangements through his LinkedIn network at the minimum. He's going to be able to show you exactly what you're going to need to do in order to put together a good property package in order to get your deal funded. What other types of JV partners are going to be looking for in order to get put money into your deal. So when you come on to our event, obviously, in addition to all the multifamily training, Jeff's going to be going through such things as what do you do when you've got partners that don't work? What do you do if you've got a problem partner? What advice can new investors get? How do you get rid of bad partners? And what types of entity structures should we use in order to make everything go very smoothly? So, Jeff, I'm thankful that you're going to be there. I think it's going to be a lot of fun. It's going to be great. Very intense training taught by two attorneys that specialize in this business. That we do deals day in and day out, and also we represent clients to make sure that they're well protected against doing bad deals. So I think it's going to be great having you there. I can't thank you enough for agreeing to speak, and I guess we will see you at the end of this month.
Sounds good. Looking forward to it. Looking forward to seeing everybody there, and. Thank you for the time and the opportunity to do this initial introduction.
Great. I appreciate it. Thank you so much, Jeff.
Okay. Bye-bye.
Bye-bye.